The U.S. Federal Reserve raises interest rates another quarter point. I'm Lisa Bernhard for Reuters. Here to talk about the Fed and more is Anna Rathbun. She is from CBIZ Investment Advisory Services. Anna, we knew that this was coming, another quarter point rate hike, but what did you make of the tone of the policy statement today from the Federal Reserve?
The tone from the Federal Reserve was just as hawkish as it was in June. And that was actually a disappointment for the markets because we were expecting that potentially this could be the end of the hiking cycle and maybe a skip, maybe a pause forever, and then maybe cuts coming in the future. But that is not what we got today. And honestly, what the markets were really excited about and what has been going around in terms of rhetoric is the CPI that was lower about 2 weeks ago. But other than that, nothing else has changed. If anything, liquidity has gotten looser in the markets with the Russell 2000, small caps rising, the Dow rising, equity markets rising in general, credit spreads compressing. All of these things are working against what the Fed is trying to achieve, which is tighter liquidity conditions and therefore taming inflation. So it is not at all surprising that the Fed left the door open for that second 25 basis point rate hike that it actually televised to us back in June.
Do you think that there's a chance that we could actually see inflation tick back up again?
Yes. So if you think about headline has been coming down because of oil prices, crude oil, energy prices, et cetera. But core has been pretty consistent. The Fed's favorite metric, the PCE, core PCE index, has been around 4.5 to 4.6% on a year-over-year basis for about 6-7 months. And so that is not showing a downward trend. So it is reasonable to expect that this will continue. And as long as the core remains high, the Fed will remain hawkish.
Picking up on earnings season, we're seeing a lot of companies beat Wall Street's estimates, right? Is that necessarily good news for earnings this quarter, or what are we seeing?
Well, even though there are beats, and it's sort of designed that way, right? Every earnings report, every quarter, you're going to see lots of earnings beats because the expectations are set a certain way. But what's important to remember is that this is the third consecutive quarter of negative year-over-year earnings growth profile for the S&P 500. And that is not necessarily conducive to getting people excited about a 20% run in the equity markets year to date. It just doesn't really jive. And of course, that leaves valuations really, really high. So the market's being on a tear, I think, is a very much a momentum-driven phenomenon that we are seeing and not necessarily supported by fundamentals, which leaves equity markets a bit on the risky side for the remainder of the year.
So speaking of high valuations, we're seeing Alphabet and Microsoft deliver strong earnings, and those stocks continue to go up. Are they justified, though? A lot of people think that they're not, and we'll see that retraction there. What do you think?
I think a lot of the hype in tech, this is a continuation from the second quarter, is the hype around AI. And it's true, AI is it's not 100% there. It's not even 90% there, but this is the essence of the growth stocks, right? Growth stocks get people excited because of the potential that lies ahead. And I think that is what is true for AI. So from that perspective, it makes sense that the valuations are high. Now, Microsoft, on its earnings call, talked about AI, but there's going to be a tremendous amount of investment that comes into play, not just from Microsoft, for any tech company that wants to play in the AI space. And in the next few years, there's going to have to be fitting of AI into different industries for actual use where rubber hits the road. So this is really a hype that we'll see fruits maybe in a few years, not right now. And for those promises, certainly the valuation is high and may justify it down the road.
So let's end on this. Markets are generally expecting that we will avoid a recession and we will have a nice soft landing. Do you agree with that?
A soft landing, I'm even hearing words like Goldilocks situation. That's like trying to land a plane on a tightrope. It is human nature to overshoot, and I'm expecting the Fed to have overshot simply because when they have a hard job. When they're raising rates, they're not going to see the impact until later because by nature, the Fed rate hikes, the impact is delayed. And it's lagged. In fact, in the statement today, they actually say that it is uncertain what the policy impact will be, but their focus is on inflation. So in my opinion, a soft landing, it's a little too early and premature to talk about a soft landing as if it's a done deal. I think we have to wait until 2024 to really understand how the rate hikes are making their way through the Main Street economy and to see the full impact. And at that point, we may actually see a recessionary environment, even if it's a shallow one.